Welcome back to my YouTube channel, Study with Clef. My name is still Caleb, as you know. So today we'll be talking about IAS 36, which is impairment of assets. Like we've been mentioning, we've been talking about IAS 36, impairment. A lot of assets that we've discussed so far has been relating to impairment. One of them is IAS 16, PP, IAS 40, investment properties, IAS 38, which is intangible assets. We mentioned impairment in all of these cases. So impairment, which is IAS 36, relates to large number of assets, a lot of them. So we'll be moving straight into the content on concept of IAS 36 today. So we'll be talking about the introduction, definition of terms, examples of assets impaired and those that are not impaired, impairment of cash generating units, which is another segment itself, then allocation of impairment to cash generating units. Then we have two illustrations from past questions. This is skills ICAN May 2024, question 4. We also have professional level CR November 2022. So this is financial reporting and this is corporate reporting. ICAN. All right. So starting with the introduction, just like I said, impairment is a permanent loss in the value of an asset, just like the name terms. So IAS 36 is an accounting standard that governs all the treatment of impairment on assets, the recognition, the measurement, the allocation, and the likes of such. So impairment itself, under the definition of terms, we have impairment. Impairment is a permanent loss or reduction in the value of an asset. So impairment arises as a result of the excess of carrying amount of an asset over the recoverable amount of the same asset. So, for example, we're saying that impairment arises, this is under the definition. So, impairment said it is a permanent loss in the value of an asset or permanent reduction in the value of an asset. So, impairment arises as a result of the excess. It is the excess of the carrying amount of an asset over its recoverable amount. That is, impairment arises where carrying amount which is CA exceeds recoverable amount. So impairment arises when the carrying amount of an asset exceeds the recoverable amount of the same asset. So we have impairment loss. Like we say that impairment is the permanent loss in the value of an asset. So it arises from the excess of the carrying amount of an asset over its recoverable amount. We've talked about carrying amount already, just when we're defining lots of terms under IAS 16 and all non-current assets that we've done so far. Like the carrying amount, we said it is the current worth of an asset. Under IAS 16, property, plant, and equipment, we mentioned carrying amount. Under investment property IAS 40, we mentioned carrying amount. So, and the likes of such. So, carrying amount is just like the present worth of an asset. Carrying amount, which is cost minus accumulated depreciation. We've talked about this before, that the carrying amount of an asset is the cost less the accumulated depreciation of the assets. So that's carrying amount. Then the other one, which is recoverable amount. recoverable amount is the higher of fair value. We just completed fair value, IFRS 13. So check the previous video on IFRS 13 fair value. So everything relating to IFRS 13, which is fair value, has been taken care of in that video. So please just go through that video so that you can understand everything about IFRS 13, which is fair value. So fair value less cost to sell So the higher of the fair value, less cost to sell, and the value in use. So recoverable amount, we talked about carrying amount. So recoverable amount is the higher of the fair value, less cost to sell, and the value in use of this asset. So carrying amount, we said carrying amount is cost less accumulated depreciation, and the recoverable amount is the higher of fair value, less cost to sell, and the value in use. So fair value, which we've mentioned under IFRS 13, is the amount that will be received to sell an asset, or the amount that will be paid to transfer a liability in an orderly transaction between market participants at a measurement date. That's according to IFRS 13, which is fair value. So then cost to sell, on the other hand, is the amount that will be paid or incurred to transfer a liability. That's cost of transaction. So the amount which will be incurred to sell an asset or transfer a liability. That's cost to sell. For example, if I have an asset to sell for 10,000 and I have to repaint that asset before I can sell it for 10,000. Let's say I have to repaint it for 2,000. Then my cost to sell will be the 2,000. So my fair value will not only be the 10,000, but 8,000. That will be the fair value. Fair value is fair value less cost to sell. When we did IFRS 13, we mentioned that fair value is done using the selling price less the transport cost. Don't forget. So that's for that. Then value in use. Value in use is the present value of the future cash flows that can be generated from the use of this asset. So value in use is the future cash flow or the present value of the cash flow generated from the use of an asset. So when we said fair value is the amount that we receive to sell an asset, value in use is the present value of the future cash flow generated from the use of an asset. So that's for that. Then we move straight into the examples. Examples of assets that are impaired. We have motor vehicle, basically all PPE items, PPE, IAS 16. We have investment properties, IAS 40. We also have intangible assets, IAS 38, intangible assets, which comprise so many. We have the goodwill, we've talked about intangible assets, IAS 38, so you may need to watch the video to understand better on that. That's if you've not done that. So these are examples. It is not limited to these, but these are just examples of assets that are impaired, subjected to impairment. And the other way around also, examples of assets that may be impaired. That's for that. Then we also have assets that may not be impaired. So examples of assets that may not be impaired. We have one, all monetary assets. Monetary assets, e.g. inventories, receivables, etc. So examples of assets that are not impaired is a monetary asset. All monetary assets are not to be impaired. You must not impair any monetary asset. Inventory is not to be subjected to impairment. Inventory has its own standard, which is IAS 2, which is measured on another level, the lower of cost and net realizable value. So inventory is not to be subjected to impairment, and every other monetary asset. So monetary assets, just like we've talked about, are those assets with a claim for future financial resources. So that's for the example. We have the impairment of cash generating unit. Cash generating unit. So cash generating units are the smallest unit of identifiable net asset, which brings in or generates cash flow independently from other groups of assets. Again, I repeat that cash generating units are the smallest unit of identifiable net assets, which generates cash flows into the entity independently from other groups of assets. So that's cash generating units. Examples of cash generating units can be PPE. Examples of cash generating units, we have PPE, is under IAS 16. You can have inventories, you can have receivables, you can have goodwill, etc. So these are examples of cash generating units. So that's for that. The next one is the allocation of impairment to cash generating units. How do we allocate impairment? For example, if we have groups of assets like this, how do we share a total impairment between these assets? So say the allocation of impairment to cash generating units. One of them is that you charge to specific assets. You charge the impairment to the specific assets. That's one. Secondly, you charge the remaining impairment to goodwill. Then lastly, you share the remaining impairment. Among the remaining assets using the pro rata basis. So we said how we allocate impairment to assets, cash generating units, is that we charge the impairment directly to the specific asset that has been specifically impaired. We give the impairment to the asset that has been specifically impaired. That's one. We charge the remaining impairment after deducting that of the specific asset. We charge the remaining to goodwill if it can be absorbed, meaning that if goodwill can take the remaining, the whole of everything, then it will be stopped there. But if there is still a remainder, we charge the remainder or we share the remainder now among the remaining assets. We share the remainder after also charging to goodwill, bringing goodwill to zero. So we charge the remaining or share the remaining among other assets on pro rata basis. Pro rata basis is on the basis of their carrying amount. So the higher the carrying amount, the higher the share of impairment. We will show these questions relating to some of this. And take note that inventories and receivables are monetary assets. And we said that monetary assets are not to be impaired. All right. So moving on, the treatment of impairment in the financial statement. So how do we treat impairment? How do we pass the entry? If, for example, we have an asset, let's say motor vehicle with a carrying amount of 40,000, and the recoverable amount, we said the impairment arises when the carrying amount is greater than the recoverable amount. Don't forget. Recoverable amount, and the recoverable amount is, let's say, 25,000. So impairment becomes 15,000. So passing the entry for this impairment now. Impairment is an expense. Don't forget, we said it's a loss, permanent loss suffered on an asset. So how do we pass this impairment? How do we pass the entry? Remember that our carrying amount is 40 million. 40,000 is what we've been recording as the value of our asset, which is this motor vehicle. So how do we bring it to reflect the recoverable amount? We said at every year end or at every point in time, an asset must always reflect its recoverable amount. Please take note, an asset must always reflect its recoverable amount at the end of every accounting period. So we have previously recorded our assets using the carrying amount as 40,000. How do we bring it to reflect this 25,000, which is the recoverable amount? For example, so how do we pass this 15,000 entry of impairment? So we debit profit or loss by 15,000, which is impairment. Then we credit motor vehicle itself, impairment, 15,000. So this is one. This is an aspect of it. So we're debiting profit or loss as a line item. It is going to be shown separately on the face of the statement of profit or loss as an expense, 15,000. So we'll also credit motor vehicle. Crediting motor vehicle means we're deducting from motor vehicle. Motor vehicle is an asset, and we've talked about this before. So if you are crediting an asset, it means we are deducting from the asset. So in case you don't know how to pass this entry, please go back to the first video where we mentioned all of this. So crediting motor vehicle is deducting from motor vehicle. So we're deducting 15,000 from motor vehicle, meaning that we're deducting 15,000 from 40,000 for it to reflect this 25,000. Then debiting expense, which is profit or loss, means we're adding 15,000 as an expense to reduce the profit. So that's for that. Then on the other hand, if there's a clause to this, if the motor vehicle had been previously revalued, meaning that if there had been a previous revaluation surplus on this motor vehicle, let's assume that last year there is a revaluation surplus of of, let's say, 8,500 last year, there was a revaluation surplus of 8,500 on this same motor vehicle. Note that it has to be on the same asset. So there's a revaluation surplus on motor vehicle the previous year of 8,500. Now we have an impairment of 15,000 this year. So passing the entry, the whole 15,000 will not go to profit or loss, meaning that we will debit the previous revaluation surplus, since there's a previous revaluation surplus on that asset. So revaluation surplus. Revaluation surplus is charged to OCI, other comprehensive income. Or we can just say we'll debit other comprehensive income with what was previously revalued. The revalued amount as at last year was just 8,500. We cannot charge the whole 15,000 against 8,500. It means what we can only charge to this 8,500 will still be 8,500. Since the asset has been previously revalued, the impairment loss suffered afterward should reduce or cancel the previous revaluation surplus. If it can remove everything, that's that. So for this case, we have an impairment loss of 15,000, but we have a previous revaluation surplus of 8,500. 8,500 cannot accommodate 15,000. So it means we can only remove 8,500 from 8,500 so that there will be no revaluation surplus on motor vehicle. So then the remainder will be taken now to profit or loss. Profit or loss, which is an expense. And we said it should be shown as a separate, on a separate line, that's as a line item, impairment. Here also, we're debiting it with impairment. So if we deduct 8,500 from 15,000, we'll be left with 6,500. So it means what we are taking to our profit or loss will be 6,500. So do you understand? We are debiting other comprehensive income by 8,500. Debiting other comprehensive income. Other comprehensive income is an income. If we debit it, it means we are deducting from it. Like I said, passing the entry, that is why I laid that foundation from the first class so that it becomes easy afterwards. So debiting OCI is deducting from OCI because OCI is an income and it has a credit entry. That's for that. Then we are now debiting profit or loss as an expense, which is impairment. If we debit expense, it means we are adding to it. So this 8,500 will cancel the previous revaluation surplus of 8,500. So that becomes zero. We will not have revaluation surplus on this asset in this current year. But we'll have impairment now as a line item of 6,500. Then the whole amount will be credited to the motor vehicle itself, motor vehicle, which is 15,000. The question we're about to solve is on something like this, which is why I need you to understand it. So that is just this. For example, also, if we have a previous revaluation surplus on this same illustration, if there's a previous revaluation surplus of 18,000, and now this year we have an impairment loss of 15,000, how do we pass this entry? We will still debit, since last year we were able to revalue this asset. Remember that it has to be on motor vehicle itself. If the previous revaluation surplus is not on motor vehicle, then we cannot charge any current impairment loss against another asset, against the revaluation surplus of another asset. So as long as it is the same asset, then we can net them off. So we are debiting other comprehensive income, which is OCI, impairment. So what we have is, since the previous revaluation surplus is 18,000, then we have a current loss of 15,000. The previous 18,000 can accommodate the whole 15,000. So we're debiting it all to it, 15,000. Then we'll credit the whole amount also to motor vehicle itself, which is a PPE item with impairment, so that it will reflect the recoverable amount of this asset as at this period, 15,000. So this is just another scenario. This is another scenario. So I believe we understand this now. So the next thing we have is the indicators. Indicators of impairment. Indicators are those things that causes impairment. Like, how do we know that our assets may actually suffer impairment, or there may be an impairment loss on our asset? So there are two ways of actually determining the indicators, or ways of actually ascertaining that an asset may be impaired or not. So one of them is the internal indicator, and external indicator. Internal indicator means that the problem or the loss arises from the company itself. So internal indicator, we have one of them to be damages. If there is any damages on an asset, then there's a probability that the asset may have been impaired or may be impaired. It may suffer impairment loss. So another one is the reduction in the useful life of an asset. So if there's a reduction in the useful life of an asset, then there is possibility of impairment on the asset. Another one is number 3, idle time. If assets should spend more time without being used, there's a possibility that this asset will be impaired. So that's that. These are just examples. For external indicators, you can have changes in market value. You can also have inflation rates fluctuation. Then we also have changes in interest rates. So these are examples of indicators of impairment. So if there's a damage on any asset, then there's a probability that that asset will be suffering impairment, or there's probability that there will be an impairment loss on that asset. Also, if there's a reduction in the useful life of an asset, impairment may arise. If the idle time of an asset is actually large, impairment may arise. Then external indicator, if there's a change in the market value of an asset, then impairment may arise. For example, if the market value of an asset drops, then there is possibility of impairment. Then inflation rates will also affect the value of the impairment due to the movement in prices of values and transactions. Then lastly, changes in interest rates. Increase in interest rates will bring a lower value of an asset, while decrease in interest rate gives an higher value of an asset. So these terms will affect our asset to be impaired or not. So this may cause an impairment loss on us on an asset. So we'll move straight to the question now. Financial reporting, May 2024, question 4. The question says, differentiate between impairment and depreciation. Impairment is a permanent loss suffered by an asset, while depreciation is a systematic allocation of the depreciable amount of an asset over its useful life. Like we've talked about, we've explained all of this under IAS 16. So in case you need to know more about that, please check previous videos to get this knowledge. Then the B part says discuss the following as contained in IAS 36 impairment of assets. Indicators of impairment. So just like we just completed, the indicators of impairment, internal and external. We have examples of the internal and also examples of the external. Then thirdly, how to identify and account for the impairment of assets. He said the impairment arises when the current amount of an asset exceeds its recoverable amount. So then the C part, a non-current asset in the statement of financial position of Zamfara Limited and SME, that's small medium enterprise, at the beginning of the financial year end had a carrying amount of 800,000. The assets had previously been revalued and there was a revaluation surplus of 50,000 relating to it in the revaluation reserve. At the end of the financial year, Zamfara Limited suspected that the asset had been impaired. It therefore estimated the recoverable amount of the asset and found this to be 600,000. The depreciation charged on the asset for the year would be 80,000. Now, as the finance manager of Zamfara Limited explained with relevant computation, the accounting treatment required in line with the provision of IAS 36. So, this question is just all about, we've talked about everything on this question. So, the company's name is Zamfara Limited. Zamfara Limited. So they said there's a non-current asset in the statement, so they didn't state specifically non-current asset. In short, a non-current asset in the statement of financial position of Zamfara Limited and SME at the beginning of the financial year had a carrying amount of, so there's a carrying amount on this non-current asset, carrying amount. So the carrying amount is 800,000. So carrying amount of 800,000. That's for that. Then the asset had previously been revalued and there was a revaluation surplus. So please take note, there's a previous revaluation surplus on this asset. So we have revaluation surplus. Which is how much? 50,000. So we'll take note of that. Then the next is relating to the revaluation reserve. So at the end of the financial year, Zamfara Limited suspected that the asset had been impaired. It therefore estimated the recoverable amount of the asset and found this to be 600,000. So 600,000 recoverable amount. So the recoverable amount is 600,000. They now went further and said that the depreciation charged on the asset for the year. So depreciation charged on the asset, depreciation charged on the asset for the year, depreciation for the year. Remember, this carrying amount is at the beginning. They said at the beginning, a non-current asset in the statement of financial position at the beginning. So this carrying amount is at the beginning, not at the end of the period. Please take note, this 800,000 is not at the end. It is before the depreciation for the year. So this 800,000 is still to be subjected to depreciation. Just like we said, the carrying amount is cost less accumulated depreciation or the current value, which is carrying amount less the depreciation. So we have the depreciation for the year now. Depreciation for the year, which is 80,000. 80,000. So if we have this, so you can say that the carrying amount is now 720,000. While the recoverable amount, as stated in the question, is 600,000. So this becomes the carrying amount at the end of the period. So the carrying amount at the beginning is 800,000, which will still be subjected to depreciation for the year. So we'll still remove 80,000 as the depreciation for the year. Then we'll now have a carrying amount at the end of 720,000, which will now be compared with the recoverable amount. We said impairment arises as an excess of the carrying amount over the recoverable amount. In this case, they've already given us the recoverable amount. We don't need to compare the fair value less cost to sell and the value in use according to what we discussed earlier. So here we have, since the carrying amount of this asset is greater than the recoverable amount of the asset, it means that there is an impairment, which is the difference between the two. Impairment of 120,000. So there's an impairment of 120,000. So if there's an impairment of 120,000, how do we pass this entry? That's what the question is saying. Say we should compute the relevant accounting treatment. So what will be the accounting treatment for this 120,000? How do we pass the entry? Since there's a previous revaluation surplus on this asset, meaning that just like the example I gave, so we will debit so accounting entries, accounting treatment or entries, or entries. So we'll debit the revaluation surplus. Remember that there is a previous revaluation surplus. So we'll debit revaluation surplus. Revaluation surplus. So which is other comprehensive income. So you can just say that we will debit other comprehensive income. With how much now? Since there's a previous revaluation surplus of 50,000 on this same asset, it was stated that the revaluation surplus is on this same asset, on this total non-current asset. It was not even given specifically. So the total non-current asset had a previous revaluation surplus of 50,000. Then we now have an impairment loss. Impairment loss in the year to be 120,000. We cannot charge the old 120,000 to other comprehensive income because the previous valuation surplus we have was just 50,000. So we can only take it to the tune of what it has previously. So what we are debiting to OCI is 50,000. So don't forget that this 50,000, the previous valuation surplus, would have been credited to OCI. So we want to remove that since there's an impairment loss. It should net each other off. So we're debiting that OCI with 50,000. We'll be left with, if we charge 50,000 to OCI, we'll still be left with 70,000. So 70,000 is to be taken to the P or L account now, which is an impairment. P or L, impairment. So which is 70,000. So, and we said that the asset must reflect its recoverable amount at the end of each accounting period. So in this case, we'll credit the non-current assets, since they did not mention which of them, non-current assets, with 120,000. So if we credit non-current assets with 120,000, it means we'll deduct 120,000 from this 720,000. We'll have the same amount as the recoverable amount, which is 600,000. So that's just passing the entry, and that's all about the question. It's a 20 marks question, which is very simple. So we'll proceed to the next one. So that's that. Corporate reporting. That's the professional level of the ICAN examination, November 2022, question 3, which is also on impairment. Evo PLC acquired a cash generating unit several years ago. The directors of Evo PLC were concerned that the value of the cash generating unit had declined because of a reduction in sale due to a new competitor entering the market. At February 28, 2021, the carrying amount of the assets in the cash generating unit before any impairment testing were goodwill 3 million, property, plant and equipment was 10 million, then other assets were 19 million, total of 32 million. Now the fair value of the property, plant and equipment and other assets at February 28, 2021 were 10 million and 17 million respectively, and their cost to sell were 100,000 and 300,000 respectively. The cash generating unit's cash flow forecast for the next 5 years are as follows. Date till year end 28 February 2022 till 28 February 2026. We have the pre-tax cash flow and we have the post-tax cash flow. The pre-tax discount rate for the cash generating unit is 8% and the post-tax discount rate is 6%. Vivo has no plan to expand the capacity of the cash generating unit and believes that a reorganization will bring cost savings, but as yet, no plan has been approved. The directors of Vivo PLC need advice as to whether the cash generating unit's value is impaired. The following extract from a table of present value factors has been provided. Year 1 to 5, the discounting rate at 6%, then discount rate at 8%. Required, how is impairment loss determined and accounted for by a business entity? B. Advise the directors of Vivo PLC on whether the cash generating unit value is impaired. Then last one, how the transaction above should be treated in its financial statement in accordance with the provision of IAS 36, impairment of assets. So that's also a question, a 20 marks question. So Vivo PLC. The first question says, how is impairment loss determined and accounted for by a business entity? Impairment loss is determined when you have the carrying amount of an asset exceeding the recoverable amount of the same asset. So when carrying amount exceeds recoverable amount, we'll have impairment loss. Remember, if the carrying amount of an asset is lesser than the recoverable amount, there is no impairment gain. I repeat that there is no impairment gain. What we can have is either there is impairment loss or you have nothing. If the carrying amount is lower than the recoverable amount, then you have no impairment. It means that there's no impairment. So there is nothing like impairment gain. All right. So that's for the first one. And then it says what will be the treatment for the impairment? How do we account for by business entity? So you debit impairment to profit or loss and credit it to the non-current asset or the assets which is preferred. Then the B part says advise the director of Vivo PLC whether the cash generating unit's value is impaired. So we need to know if the cash generating unit value has been impaired or not. So we need to test, we need to check impairment. So cash generating unit, the cash generating units were given, we have CGUs, we're given goodwill, we're given PPE, which is property, plant and equipment, we're given other assets. So we have this million, we have 3 million here, we have 10 million here, we have 19 million here, making it 32 million. These are the cash generating units. So we want to check. We said we have to compare their values with, this is the carrying amount of the cash generating unit. It says that at February 28th, the carrying amount of the assets of cash generating unit before impairment testing were 3 million, 10 million, and 19 million. So before impairment, these are the carrying amount. 32 million, so 32 million is the carrying amount. So we need to compare, before we can have impairment, we have to compare the carrying amount with the recoverable amount. And we said recoverable amounts, remember, recoverable amount is the higher of fair value less cost to sell. So according to this question, we're given the fair value of the assets. So they said the fair value of the property, plant and equipment and other assets as at February 28, 2021, so as at the year end, is the fair value. So let's assume that this is for PPE, property, plant and equipment, PPE. Then the other one, which is other assets, is in millions. In millions. So the fair value of property, plant and equipment were 10 million and 17 million respectively. So fair value of PPE is 10 million, while other assets is 17 million. Then the cost to sell for these assets, we're told that, and their cost to sell were 100,000 naira and 300,000 respectively. So 100,000, because this is suspended in millions, so 100,000 divided by 1 million will give you 0.1. So that's 0,100,000 because it is suspended in millions. So while deducting cost to sell, don't forget, they will also deduct 300,000 rather, which is 0.3 million. So 300,000 is 0.3 million, while 100,000 is 0.1 million. So the fair value less cost to sell now. Fair value less cost to sell. It's just an acronym. So the fair value less cost to sell, this becomes 9.9, and this becomes 16.7. So that will give us the fair value less cost to sell. So they said we should compare the fair value less cost to sell with the value in use. Value in use. So the value in use of this asset. So the director of EVO needs to advise whether there has been impairment. Okay. We were given the cash flow for the CGU's forecast for the next 5 years were given. So value in use, we said these are present value of the cash flow generated from the use of the asset. Value in use is the present value of the future cash flows generated from the use of the assets. So the value in use of these assets will be give us value in use for the CGU. We have the date, we have years, which is yes, that's year ended. We have 28th February for all of them. So we have 2022, we have 2023, we have 2024, we have 2025, and we have 2026. So we are going to be using the post-tax cash flow, not the pre-tax cash flow. The relevant cash flow to be used is the post-tax cash flow. For them to have given us post-tax cash flow, meaning that tax have been deducted. So we're using the post-tax cash flow, not the pre-tax cash flow. So the post-tax cash flow post-tax cash flows is also in millions. We're given for 2022 we have 5 million. For 2023 we also have 5 million. Then we have 3 million. Then we have 1.5 million, and we have 10 million. Then we have to discount this. The discounting cash flow. They have already given us the discounting cash flows. So we're also using the post-tax discounting rate, which is 6%. So we're using 6% as our discounting rate. 6%. So 6% for year one will give you, which has already been provided. Discount factor is 1 plus r raised to power minus n. So I don't know, 1 plus r raised to power minus n. That's how you get this discounting cash flow in case it was not given. But in this question, it has been provided. So 2022, we're given that the discounted uh, rate is 0.9434. Then this is 0.8900, 0.8396, 0.7921, then 0.7473. So these are the discounting rates. Then we now have the present value. So here we are going to multiply each of them by the discounted rate. So 5 multiplied by 0.9434 will give us 4.72, approximately 4.72 million. So 5 also multiplied by 0.8900, 4.45. We also have 3 times 0.8396, which is 2.52. Then we have 1.5 times 0.7921. We have 1.19. Then we have 10 multiplied by 0.7473. So we have 7.47. So the addition of all of this gives us the present value. So the addition of everything, which is 4.72 plus 4.45 plus 2.52 plus 1.19 plus 7.47 gives us 20.35. So the value in use is 20.35. So our value in use is 20.35, while our fair value less cost to sell. So the addition of our fair value less cost to sell equals total fair value less cost to sell gives us 9.9 plus 16.7, which is 26.6. So our fair value less cost to sell is 26.6. So value in use is 20.35. Remember that we said our recoverable amount is the higher of the fair value. Now we've gotten the total fair value less cost to sell, and now we've gotten our total value in use. So the higher of the two becomes our recoverable amount. So the higher of the two is the fair value less cost to sell. So automatically our recoverable amount equals to, don't forget this and not, we're just comparing them, equals to the 26.6 million. So this becomes our recoverable amount. Then we are now told that, or we know now that impairment arises when the carrying amount of an asset exceeds the recoverable amount. So the carrying amount is 32. Now the recoverable amount is 26.6. So automatically there's an impairment. So impairment equals to 32, which is the carrying amount, minus 26.6 million. So this gives us the impairment. The carrying amount is greater than the recoverable amount, so there is impairment. So 32 minus 26.6. So there's an impairment of 5.4 million. So there's an impairment of 5.4 million. So that's the end of the impairment question, and I hope you understand how the treatment of impairment works. IAS 36, which governs impairment of assets. We've talked about the terms, the definition, the introduction, talked about the assets which are impaired, the assets which are also not impaired. We've talked about cash generating unit itself and the impairment of cash generating unit. We also talked about how we allocate impairments to cash generating units. Then we did the differences between the internal indicators of impairment and the external indicators of impairment. Then we took a comprehensive question on this particular standard. So I hope we understand the scope of IAS 36 and all about it. So thank you very much for sticking by, and also I would really love to hear your comments. In case of any question, please use the comment section and we'll revert back as soon as possible. So thank you very much once again. And my name still remains Caleb, and this is Study with Clef. So please like, share to as many as possible people, and also subscribe. So thank you very much. I believe I will see you next in the coming video. Thank you very much.